Hello and welcome to the sixth episode of the Special Situations Report, a podcast by Inside Arbitrage, covering the most intriguing event-driven activity over the past week. In this podcast, we'll dive into the latest M&A activity, upcoming spinoffs, significant buybacks, unique insider buying, activist campaigns, and a whole lot more.
My name is Tamanna Suria, and I currently attend the University of California, Los Angeles. And if you're noticing a different environment today, it's because I'm back home for the long weekend.
And my name is Asif Suria, and I'm coming to you from the beautiful San Francisco Bay Area. This week, we will briefly cover progress on the hostile bid for Beacon Roofing Supply by QXO, Elliott Management's involvement in Phillips 66, Lyft announcing their first stock buyback, an insider purchase by Match Group's new CEO Spencer Rascoff, management changes at Avis Budget Group, and a whole lot more.
Before we begin, it's important to state that this podcast is for general informational and educational purposes only. The content does not constitute financial, investment, legal, or tax advice. We do not warrant the completeness or accuracy of the content or data provided in this podcast. Nothing discussed in this podcast should be interpreted as a recommendation to buy, sell, or hold any investment or security. Investing involves substantial risks, including the potential loss of principal. You should conduct your own research and due diligence before making any investment decision.
Let's start this podcast with M&A, both announced mergers and acquisitions, as well as potential mergers, which we like to call as deals in the works. Overall, M&A activity slowed down last week, with the biggest deal announced was a $2.6 billion acquisition of Playa Hotels and Resorts by Hyatt Hotels for $13.50 per share in cash. We discussed this potential deal in our last podcast, and we're wondering why Hyatt was buying a hotel owner when its strategy has been to move to an asset-light model like its competitors Hilton and Marriott, who own less than 10% of the hotels that have their names on it. So when you come across a Hilton or a Marriott hotel, it's quite likely that it is a hotel REIT that owns it and not necessarily Hilton or Marriott.
It looks like Hyatt plans to eventually sell the underlying physical hotels that Playa owns for at least $2 billion by the end of 2027. Considering Playa owns or manages several hotels that have the Hilton, Wyndham, or Kimpton banners, this approach to M&A is very interesting.
And their hotel and resorts are very interesting as well. I was taking a look at a few of them, and they just are in wonderful locations in the Dominican Republic and a few other places. Switching gears a little bit and looking at pre-deal situations or deals in the works, the hostile bid for Beacon Roofing Supply by QXO entered a new chapter. Last week, we discussed the use of poison pills to ward off a hostile acquirer and how in some cases that defense has not worked. Beacon Roofing Supply could become another example of a poison pill not working.
Not only did QXO and its CEO, Brad Jacobs, propose 10 independent director nominees for Beacon's board, but they also indicated that they have obtained antitrust clearance in both the U.S. and Canada for their acquisition of Beacon. This is highly unusual, obtaining antitrust clearance before a deal was even agreed upon by the target.
Yeah, I was very surprised to see that happen. The tender offer, which is still active until February 24th, is for $124.25, and the stock is trading at about $119.39. So you still have almost $5 worth of upside left on this deal. The obvious risk is that Beacon is able to fend off QXO, and the stock drops back to the pre-bid price of about $100. The upside, on the other hand, is that QXO bumps up its offer and Beacon eventually agrees. I was just reading on the Financial Times that Beacon has hired an investment bank and paid them $4 million for 3 days of work to claim that the QXO offer undervalues the company.
Insane amount of money then. Continuing on, it's been rumored that the U.S. cancer and rare diseases drug maker SpringWorks Therapeutics is set to be acquired. The German healthcare giant Merck Group announced earlier this week that they were in advanced talks to acquire the company, though no legally binding agreement has been signed, and like all rumored deals in the works, there is no certainty that a deal will come to fruition. Just to be clear, this Merck is different from the US-based Merck & Company, though both companies did once share the same parent many, many decades ago. Coming back to the deal at hand, SpringWorks has a number of drugs in its pipeline, but its two flagship and commercialized drugs treat desmoid tumors and neurofibromas respectively. And for our non-science listeners out there who don't quite understand what these diseases are, because I certainly didn't prior to our research, desmoid tumors are tumors in the connective tissue in our bodies, and neurofibromas are tumors that develop on our nerve cells.
When this deal was announced, shares of SpringWorks jumped by over 45%, and the stock now trades at around $57 per share. Given this big jump in stock price, it'd be interesting to see if the deal goes through and at what price Merck will acquire each share of SpringWorks. The acquisition is quite interesting for a couple of reasons. Merck Group recently acquired the life sciences research company Mirus Bio in 2024 for $600 million in cash. This acquisition is a first since the Mirus Bio deal, which was announced back in 2023, and SpringWorks is quite interesting as a standalone company. We were quite drawn to the management team as the CEO was a founding member of the company's executive team and previously served as CFO and Chief Business Officer. He was previously the Chief Business Officer at Moderna.
Quite frankly, it feels as though we should call this show the Elliott Management Tracking Show, because it seems as if we're talking about the activist investment firm practically every single week. This week, Elliott sent a letter to the board of Phillips 66, one of the nation's largest oil and gas companies operating in the downstream, meaning refining and transportation, business. Elliott unveiled a new plan to improve Phillips 66, which they've aptly titled Streamline 66, a plan we'll discuss in a little bit. This isn't the first time that Elliott has engaged with Phillips. They first sent a letter to the company in November 2023, after they took a $1 billion position in the business. The activist investment firm expressed its displeasure with Phillips' underperformance compared to its peers, its loss of focus on its primary business of refining, and failed attempts to reduce operating expenses. Elliott asked that 2 new directors with refining operating experience be added to the board, an initiative that Phillips did not follow through on.
Now it seems as if Elliott has come back in full force. Their most recent letter to the board revealed that the firm has now built up a $2.5 billion stake in the company, and their new Streamline 66 plan has 3 clear objectives. 1, an overhaul of the company's conglomerate structure. 2, improvements in its operating performance. And 3, a refresh of the board and executive team. At this point, Elliott is encouraging Phillips 66 to spin off any non-core business operations, including their midstream business, which Elliott values at over $40 billion. Elliott is also encouraging Phillips to sell off its joint 50% stake in CP Chem, an R&D energy resource initiative it shares with Chevron. Lastly, Elliott emphasized the frequently discussed sale of Phillips' jet retail operations in Germany and Austria should actually be executed.
The other 2 points are actually simpler. Elliott wants Phillips to close the widening EBITDA per barrel gap with its peers and also wants to add in new independent directors to the board. While no explicit plan has been announced to completely remove the current C-suite team at Phillips, Elliott has been pointing to their successful turnaround of the refineries company Marathon Oil as a potential playbook for how the Phillips turnaround may execute. At Marathon, in addition to sales of divisions and operational cost reductions, Elliott brought in a new CEO. We're still in the early stages of this Elliott and Phillips 66 engagement, but I'm excited to see how it turns out, as it seems as if every single week, Elliott comes swinging out of the gate with some new business improvement plan in hand.
They have certainly been very active in the special situations place, and it's interesting for us to see all the different ways they are playing things with Southwest Airlines, now with Phillips 66, and so on and so forth. Let's switch for a minute to stock buybacks. And so there were a couple of interesting buyback announcements over the last week. The ride-sharing company Lyft announced its first stock buyback with plans to repurchase $500 million worth of stock, representing 8.5% of its market cap at announcement. Their trailing 12 months of free cash flow was $766 million. Like most tech companies, their stock-based compensation expense is very high, and they spent $331 million on it in 2024. So this allocation to the stock buyback is actually quite large. Just like Uber, this stock-based compensation is coming down sharply, and they are starting to report GAAP positive net income. For the full year, revenue was up 31% to 5.8 billion. Quite often I use Uber and I don't really think much about Lyft, but this stock buyback announcement, along with the GAAP profitability and this increase in full year revenue, is making me take a second look at this company.
These days, many investors are worried that self-driving taxis offered through Google's Waymo and other businesses could disrupt companies like Uber and Lyft. Bill Ackman's Pershing Square, who we've discussed extensively in previous podcasts, due to their potential acquisition of Howard Hughes, recently made an investment in Uber and made the case in their annual presentation that large-scale U.S. autonomous vehicle rideshare is unlikely for many years, and that Uber will become a partner for autonomous vehicle companies in the future, potentially.
I just had a bright idea. Let's call this the Bill and Elliott show instead of the Elliott Management tracking show. Anyways, getting back to the show, considering both Amazon and Google have a large user base and hence an established network, their need for a partner that brings network effects to the table is low. Now, if it was someone like GM's Cruise, a partnership might make sense. This got me thinking about Lyft and how it could be a perfect partner or even an acquisition given its low enterprise value for a company like Cruise or even Amazon that is working on autonomous driving through its acquisition of Zoox. If you remember, when you were learning to drive, we used to see Zoox cars on test runs all the time.
Yeah, it was kind of funny because I was learning to drive alongside the self-driving cars. Moving to another buyback by a company with a lot of stock-based compensation, this week, DoorDash announced a $5 billion buyback, inclusive of the $876 million under the previous share repurchase authorization, representing approximately 5% of the company's market cap at announcement. DoorDash is an excellent executor that has been seeing some impressive revenue growth, and in 2024, the company finally flipped to generating positive GAAP net income. Total orders for the year grew by 19% year over year to 685 million. This buyback would be impressive if not for that aforementioned stock-based compensation, which, as you can see, the company's shares outstanding have been growing steadily over the last few years, and this buyback is more likely done to offset the dilution. So a lot of similarities to Lyft, as we just discussed.
It's actually quite fascinating to see some of these companies turn and become GAAP profitable, because this was one of the criticisms investors had about these companies, that they're giving too much away to employees and there's not much left over for investors. I also remember talking to a friend of mine who runs cloud kitchens here in the Bay Area, and he used to characterize these kind of businesses like DoorDash as lose businesses, where the company like DoorDash loses money, the hotel or the restaurant chain that is partnering with them is losing money, and so are consumers because of all the fees involved. Clearly, DoorDash is proving him wrong, at least for the time being. Another quick buyback we would like to cover is Post Holdings, a consumer packaged goods company that makes cereals you may recognize, such as Honey Bunches of Oats or Fruity Pebble. They just announced a $500 million buyback, representing almost 8% of its market cap. The interesting thing to note here is that Post did still have $200 million left from a previous share repurchase authorization and has cancelled that prior buyback authorization in favor of this new and larger buyback. Post has been generating some pretty steady cash flow, though revenue and net income remain relatively flat. So using this excess capital to repurchase shares makes sense if they're not able to find new opportunities to invest the capital.
Last but not least, the ever-popular shoewear company Crocs jumped up by 24% last Thursday. Crocs is a company we've written about quite a few times in the past. It perpetually appears cheap and currently trades at a PE of 6.83. Despite being down 6% in the last year, Crocs is up 180% over the last 5 years. The company has been performing quite well financially and has also consistently been announcing buybacks and executing on them, which is important as we'll often see companies announce large share repurchase authorizations, but never actually follow through on buying back their own stock. Crocs has bought back 13% of its shares outstanding in the last 4 years, even though they momentarily suspended the buyback program in December 2022 to repay debt. They recently announced a $1 billion increase to the share repurchase authorization, which represents roughly 16% of their market cap. So pretty large buyback over here.
Yeah, and that debt you were talking about was mostly related to the Hey Dude acquisition that they made. That acquisition hasn't gone quite as well as they had hoped for, and they've been working for several quarters to turn around that segment of the company. And I feel like this buyback announcement is signaling the market that I think we are in a good place now with that Hey Dude acquisition and ready to start growing again. Switching gears and looking at insiders. In our previous episode, we talked about Spencer Rascoff's appointment as the new CEO of Match Group. He was a co-founder of Hotwire, which was sold to IAC, and he also co-founded Zillow. Last week, we saw 2 insider purchases at Match Group. Spencer Rascoff purchased a little over $2 million worth of Match stock, and a director, Glenn Schiffman, purchased a little over $100,000 worth of stock in an open market purchase. It was unusual to see Spencer Rascoff announce his $2 million purchase on Twitter. This is reminiscent of Harold Hamm buying shares of the fracking company Continental Resources in 2020 and issuing a press release indicating how undervalued the company was. I normally look at these kind of announcements, whether it's through press release or through Twitter, which is now called X, as a negative signal. But in the case of Continental Resources, Harold Hamm went on to take the company private at a price that was more than 400% above his purchases in 2020.
Upon seeing the Match Group purchases, particularly Spencer Rascoff's purchase, we were curious to see if there was anything in his employment agreement where he would get additional stock if he purchased some on the open market. This isn't particularly unusual, since when Bill Reddy, the CEO of Pinterest, purchased $5 million worth of shares in 2022, he indicated in the footnotes of the Form 4 filed with the SEC that his employment agreement granted him additional shares if he purchased $5 million worth of shares on the open market.
And that's exactly why it's important to read the footnotes of SEC filings, including Form 4, like we do almost every night. We also saw the same thing when Workday's new CEO, Carl Eschenbach, purchased $2 million worth of shares in 2023. There was nothing in the footnotes of the Form 4 filing to indicate that he would receive additional restricted stock units following this purchase. However, that $5 million Pinterest purchase you were just referring to made me curious whether his employment agreement, not unemployment agreement, had a similar clause. A few pages in, I found a clause where he would get additional special RSUs worth $5 million, provided he purchased $2 million worth of stock in the public market. So that's quite a good return on his capital, buying $2 million worth of stock and getting $5 million from the company. This seems to be a common thing in employment agreements of tech company CEOs, because Snowflake's new CEO, Sridhar Ramaswamy, has a similar clause as well.
Now, we combed through Spencer Rascoff's employment agreement, and while it is very generous with RSUs and PSUs, there was no clause giving him even more shares or restricted units if he bought stock on the open market. The PSUs are solely dependent on Match Group's stock performance over the next couple of years.
As I was thinking more about Match Group and the fact that dating company Bumble's co-founder is also returning to the role of CEO next month, I couldn't help but thinking that this could be a match made in heaven, and a more benevolent FTC might even let a merger between Match and Bumble go through. However, considering that the two companies own the 3 most popular dating apps between them, it's highly unlikely that a merger will be allowed to go through. But I can always hope.
You can always hope. I remain very doubtful that a merger will happen, but we'll never know. Moving on, we talked about Avidel a few episodes ago due to open market purchases by multiple insiders, and the fact that the company appeared to be at an inflection point following the commercialization of its drug to treat excessive daytime sleepiness, also called narcolepsy. The new drug is superior to Jazz Pharmaceuticals' existing drug that requires patients to wake up in the middle of the night to take a second dose. Jazz sued the FDA, but a court ruled in the favor of both the FDA and Avadel, which is a huge loss to Jazz, because at one point, Jazz's 2 drugs to treat narcolepsy generated $2 billion in annual sales.
That's a pretty significant revenue for drugs that Avadel now could potentially grab a big share of. We wanted to also provide a small update on the company since Stephen Braverman of the ASL Strategic Fund sent a letter to the chair of Avadel's board, Jeff Gloss. The part of this letter that was very interesting was not just that this investor wanted the company to hire investment bankers to explore strategic options, but claimed that the pending lawsuits by Avadel against Jazz for delaying and obstructing the launch of Lumirace prevented it from generating 18 months of peak revenue, or approximately $1.5 billion. I'm going to read the next part of the letter verbatim because it is highly unusual considering Avadel is trading at about $9 per share. This lawsuit was brought under the Sherman Antitrust Act. Any damages granted by the jury, if the company is successful, will be automatically trebled. This could result in damages of approximately $4.5 billion, or approximately $45 per share.
Whether or not these damages will actually come to fruition is entirely unknown, and the steep price of $45 per share make them seem quite unlikely. But it's an interesting thought nonetheless. It does remind me more of our hypothetical Match Bumble acquisition or merger opportunity, in the sense that it's more of a pipe dream than anything else. But I'm interested to see the outcome of the lawsuits at the end of the day.
Yeah, it's a long shot, but this wasn't part of a thesis when we wrote about Avadel. We were mostly focused on their superior narcolepsy drugs, not necessarily any outcome from the lawsuit being favorable for Avadel. Moving on to yet another insider purchase, we wanted to cover a purchase at Amcor, a large cap company that develops, produces, and sells packaging products. There's been a series of interesting event-driven activity at the company, including a divestiture, as Amcor agreed to sell specialty tapes business to the private equity firm Nordic Partners in November 2024 for a purchase price of $540 million. In that same month, Amcor announced that it would acquire the plastic packaging products company Berry Global Group for $18.23 billion in an all-stock deal. This deal is expected to close in mid-2025, and the shareholder approval is set to be obtained in late February. So we love these situations where multiple things come together, and so Amcor was something that caught our eye this week.
Right, in the middle of all this special situations activity, it was interesting to see both the CEO and a director of Amcor purchase shares this week. The CEO has been with the company since 2010 and officially became the CEO in September 2024 after serving as the interim CEO since April 2024 and the chief commercial officer between 2020 and 2024. So this is someone who knows the business well and is purchasing shares after the announcement that a part of the business will be sold off and Berry Global will be acquired. So lots of change at the company, but it looks like someone with good experience in the business has renewed confidence in the stock and is thus purchasing shares on the open market.
Last but not least, we want to cover a purchase at the microcap company Enanta Pharmaceuticals. This purchase stood out to us not necessarily due to the company, but more due to the timing of the purchase. The CEO purchased roughly $250,000 worth of Enanta stock this week, which was interesting since he had just sold shares at a higher price back in December 2024. Flip-floppers have a bad reputation in politics. People like to see the politicians hold fast to a set of principles or beliefs instead of changing them on a whim. Unfortunately, the reality is quite different from people's expectations of their elected officials.
On the other hand, in financial markets, flip-flopping is actually a good sign. When new information becomes available, it's best to change your mind instead of doubling down on your existing position. All the best investors, including Warren Buffett, have done it. Flip-flopping among company insiders is rather rare, as insiders who were purchasing shares on the open market don't suddenly start selling their shares en masse. Nor are you likely to see chronic sellers turn into buyers of their company's stock.
Besides the signal this kind of behavior would send to the market, the other reason for this reluctance to switch sides has to do with the SEC. The SEC does not want insiders to engage in short-term trading and requires them to give back any profits from trades that happen within a 6-month period. This piece of regulation is Section 16B of the Security Exchange Act of 1934, otherwise known as the short swing profit rule. The rule states that if an insider of a company buys and sells, or the other way around, sells and buys stock of the company within a 6-month period, they have to disgorge profits from these matchable trades to the company. Or in other words, they have to give back all the profits from these trades to the company.
The rule is used to discourage insiders from using the information they possess to make short-term profits. Every once in a while, though, we come across insider transactions where the insider indicates that the transaction violates the short swing profit rule. In most of these cases, the footnotes of the filing indicate that the insider is going to return any profits from the prior trade back to the company. Flip-flopping insiders are sending us a signal that they think the prevailing winds have changed and that they are willing to give up some short-term profits to make even more money in the future. We track this special group of insiders by the premium flip-flopper screen on our website.
This purchase by the CEO fell under a flip-flopper categorization, and he noted in the filing that he would give back profits from this trade. And this goes back to what we were discussing earlier about reading the footnotes of filings, where you might find information about flip-flopping trades, or you might find information about purchases made because of a clause in an employment agreement.
Moving on to C-suite transitions. Last week, Southwest announced a new CFO appointment, with Tom Doxey taking the reins from long-term CFO Tammy Bromo, who was with the company for more than 33 years, including 13 years in the role of CFO. The appointment of Tom Doxey becomes effective as of March 10, 2025. He previously served as the president of Breeze Airways for a little over 2 years, and before that, held VP and SVP roles at Discount Airlines, Allegiant, and United Airlines.
This change in the management team at Southwest once again has Elliott's fingerprints all over it, as they've been very actively involved in an activist campaign against Southwest Airlines. The appointment of a new management team also sometimes comes with layoffs, and Southwest is no exception. The company announced its first ever layoffs, with 1,750 jobs cut among its leadership ranks.
Moving on to another C-suite transition, Lattice Semiconductor saw the appointment of a permanent CFO after its previous CFO, Sherry Luther, resigned more than 4 months ago, and Tanya Stevens stepped in acting as interim CFO. The new CFO of Lattice, Lorenzo Flores, comes over from Intel Foundry, where he was CFO for less than a year. We bring up this transition for a couple of reasons. Mr. Flores is also the vice chairman of Kioxia, a Japanese flash memory company that has a joint venture with Western Digital and that went public just 2 months ago. We briefly mentioned Kioxia when we wrote about the upcoming Western Digital spinoff of its SanDisk flash business and when we discussed it on the podcast a couple of episodes ago.
Lattice was also interesting to me because it reminded me of an acquisition of the company by Canyon Bridge Partners that was blocked in 2017 on national security concerns by the Trump administration. Canyon Bridge Partners was a Chinese-backed private equity firm, and the acquisition of a semiconductor company like Lattice by an international firm did not pass muster with the Committee on Foreign Investment in the United States, which is fondly referred to by arbitrageurs as CFIUS. For the final C-suite transition we want to talk about today, I was a little saddened to see that Joseph Ferraro stepping down as the CEO of Avis Budget Group, effective the end of June of this year, as part of a planned transition to Brian Choi, who is currently the Chief Transformation Officer of the company. Joseph Ferraro was with Avis Budget Group for 45 years and took the role of CEO just 2 months before the COVID-19 pandemic hit. The stock dropped from $50 per share to just $7.78 in less than a month. I think he did an admirable job managing the company through a very difficult period, And I have a case study in my book, The Event-Driven Edge in Investing, about the company and how we worked with Chairman Bernardo Hees to turn around the company.
In that turnaround, they immediately canceled new car orders, sold 35,000 cars from their fleet in March 2020, and then sold an additional 100,000 cars in the second quarter of 2020. They cut back on executive compensation, announced layoffs, and removed $1 billion of annual costs, staving off bankruptcy that its competitor, Hertz, succumbed to. When things finally started to turn over, they retired nearly a third of their shares outstanding through buybacks in both 2021 and 2022.
The last few quarters have, however, not been very strong for the company, as revenue seems to have either flatlined or declined, and earnings have gone down. So the leadership transition at this time makes sense. I think Brian Choi has some very large shoes to fill when he takes over the top spot at Avis Budget Group.
And that wraps up our 6th episode of the Special Situations Report. What we've covered today is just a brief overview of the special situations landscape, so if you'd like to access a more comprehensive weekly overview of all event-driven activity, go ahead and check out our website, thespecialsituationsreport.com, for daily updates and alerts on the special situations world, as well as access to tools to help you identify opportunities, such as the merger arbitrage tool. Visit InsideArbitrage.com.
If you enjoyed this podcast, please take a moment to like and subscribe on whatever platform you may be listening on, and especially share it with your friends who might be interested in special situations or event-driven investing. Thank you.